All right, so today I'll make a quick, well, it won't be a quick video, but it'll be a portfolio update. So notice my equity has dropped to 105. It used to be 120 not long ago. And that's actually with, I think about between $1,500 to $2,000 a month extra contribution to my accounts. And it still dropped to 105. And at some point this week, it was below 100, the total equity line over here. So it was definitely a rough week. And I think most of my negative equity comes from my Spotify trade. So I'm going to go through all my open positions across all my 4 accounts with Questrade. So margin account, TFSA, RSP, and RESP. So if you look at my margin account, you could see the total equity is negative. So that's because of the market value. So the market value has gone up to, gone down to negative 21K. I'm looking at the all in Canadian, or let's just look at the US column. Because as you can see, I have nothing in Canadian, it's all in US. So I've got 5,900 US cash. I've got a negative market value of 17.5. So now people will see negative, they'll think, am I paying interest? No, I'm not paying interest because my cash line is not negative. My cash line is positive. You only pay interest in a margin account if you're borrowing cash from the broker. In this case, I'm not borrowing cash. I'm just in a losing position. If I close all my positions right now in my margin account, I'd lose 11,000 US. In that case, I'm going to have a negative cash balance if I close all my positions right now in my margin account. But right now, it's just an unrealized loss. And the reason why my market value is negative is because most of my positions are short options, are short puts. So let's go through my positions one by one. So in my margin account, I only sell options. That's all I do in my margin account. So the position that I have right now, I've got a May 21st put credit spread on AI, 65.55 put spread. So the short leg is 65, the long leg is 55. Now, this was initially a 5-point wide spread, but in having to manage it, I ended up increasing the width of the spread, and I brought the strike slower. I don't remember what it was initially. I think it was maybe 75. I think it was 75-70 put spread. I ended up turning it into a 65-55 put spread. And now I think it's also breached. So if we look at AI, it's at 51. So even the long put is breached. So what am I going to do with that? I'm going to wait till May 21st. I'll either do the same thing, rolling it down again by increasing the width of the spread. So I'll go from 65.55 to maybe I'll go to 55.40. So now it's a 15-point wide spread. But then I'll take a further expiry, of course. Or I could turn the trade as a naked put. So I can convert it into a naked put. But the problem with that is AI is a 50% margin requirement stock. So if I look up the quote, it's actually a 40%. It's actually a 40% margin requirement stock. So it's actually not bad. It's actually better than Tesla. I think Tesla is a 50% margin requirement stock. Yeah. So Tesla is more volatile than AI. That's funny. All right. So it's a 40% margin requirement stock. So maybe I could turn it into a naked put. Might be easier to manage. Or I could continue increasing the width of the spread and then turn it into a naked put afterwards. If the new spread gets breached again, then I could turn it into a naked put again as well. So I'll decide next week, I guess. I saw it expires next week, May 21st. And the other thing I could do is, because it's a 40% margin requirement stock, and let's say I want to be efficient with the capital in my TFSA and margin account, then I could push this to my RSP account, which is all cash. There's no borrowing. And I could convert this into a naked put, which is then converted into a covered call. So how would I do that is a naked put. Basically, if I have a short put, 55 put, it's equivalent to a 55 covered call. So because you can't sell puts in a registered account, so I would just buy the covered call. So it would take up 5,500 of cash. Let's say if I take the short put of 55, but I would do it as a covered call in my RSP account. This way, I'm being more efficient with my capital in my margin account, which is borrowing. So you want to borrow as much, or you want to be efficient in borrowing. if you're using 100, if you're playing a 50% margin requirement stock or a 100% margin requirement stock, then you're basically using your own cash. You're not really borrowing. So that's the plan with this put spread here. Beyond Meat was an earnings trade that went bad. I rolled it to June 18. So it was basically the same strikes, and I rolled it as is for a very small credit, I think 15-cent credit. And let's see where Beyond Meat is at right now. It's at 105, but I still have it until June 18, so I'm not going to do anything right now. Curry was a naked put that expired May 21st. I just rolled it yesterday to the same strike. So I had a 17.5 strike expiring May 21st. I rolled it for the same strike, and I actually collected an extra credit of, if we look at, where's Curry? I collected an extra credit of 65 cents, but I went from May to November, so that's very far. But I collected an extra credit, which brings my break even lower. So if I look at my spreadsheet here, Curry is down here, of course, because this is November now. So see, total credits that I received from this short put is $3.32. So that means my break even is about $15, right? Or actually, yeah, a little bit less, $14.50 about. That's my break even on Curiosity Stream. And where is Curiosity Stream right now? I think it's below $10. Very sad. This $9.11. So that's terrible. It's not even funny. All right. Next, I've got two Etsy put spreads. I don't know how that happened, but I had a put spread on Etsy for earnings, but I started the trade. I opened the trade maybe a few days before earnings, and then between the day that I opened the trade and earnings announcement, the stock kept dropping till it reached my short strike. So I actually rolled it before earnings announcement. So the one that I rolled was this one here. So this was the 180, 175. I had a 180, 175 for earnings. I rolled it before earnings to the same strikes, but I rolled it to June 18. So I collected an extra credit. I don't really remember. Actually, let's look at the spreadsheet here. So it's June, sorry. So June 18, Etsy is right over here. So I collected an extra 15 cents by rolling it as is to June, just to give myself more time. Etsy, of course, dropped a lot after earnings, and it ended up getting breached. It's actually at 163 right now. So then I played another put spread right before earnings, which also ended up a loser. It got breached. So this is this one here that I tried to save. So so that put spread that got breached right after earnings, I pushed it to December, and I increased the width of the spread 150, 140. So now I've got two spreads on Etsy, but one of them is December, one of them is June. So December is very far. If the sell-off doesn't continue to December, it should be fine. It should come back. It's already above 150, but it has to stay above 150 by December. That's for this one here. For this one here, it's shorter term. It only has until June, so it's got 32 days to go. It has to come back up above 180. It probably won't. So I'll have to try to manage it either by increasing the width of the spread or by maybe selling a call spread and just accepting max loss on the trade. So that's really, I think, the two ways I can manage this put spread here. I would not turn it into a naked put because of the margin requirement on the stock. Plus, I don't want to own Etsy at $180. It's too expensive. Yeah, it's a 50% margin requirement stock. So I'm not comfortable rolling it as a naked put at that price level. Especially that all-time highs was only 244. So you're basically doing a naked put at near all-time highs. I don't feel comfortable at that price. I mean, if it's a naked put at around maybe 130, 120, it feels a bit safer, but not at around 180. So this 180, 175 put spread, I'd either manage by rolling it as a spread or by taking the loss. All right, so next I have a HIMS naked put. So this was a 17.5 strike for May 21st that I rolled yesterday. So if I go to orders executed, see HIMS here. No, it went from May 21st to November 19. So I kept the same strike, collected an extra 20 cents on that one. So that's a 17.5 strike. HIMS, I've collected a total of $2.62. So this is about a $15 break even. So my break even is $15 by December 17. And now if I go back to Questrade, so now I've got Lemonade. This one expires May 21st. It expires next week. It's a put spread, 80.75 put spread. So my short strike is 80. And you could definitely see from the prices here that it's completely breached. Yeah, Lemonade's at 70. So it's close, but it looks like it's going to stay below my short strike. So that's not good. Lemonade, now there's two ways I can manage this trade. I could increase the width of the spread and roll it forward. So turn it into a 10-point wide put spread and roll it forward. Or I could turn it into a naked put. So let's look at Lemonade. I think it's a 30% margin requirement stock. So this one I feel comfortable rolling it as a naked put. So yeah, 30% margin requirement stock. I'm at a $70 level and the stock had a high of 183. So I would feel comfortable rolling this as a naked put, which will be easier to manage. I can maybe get out of the trade sooner. So this is really, I could do it as a naked put or I could increase the spread. I'm comfortable either or, but I'll decide that next Friday. Lightspeed is a naked put at a 55 put. This is an accident. I actually meant to open the June expiry. I accidentally sold the August expiry for $4. Right now it's trading for about, well, it says here 650, but it's after hours, so it might not be accurate, but it's not ready to be closed yet. But I'm not too worried about it because that puts my break even at $51. So I don't mind Lightspeed at $51 as a break even. So I'm not too worried about that. Worst case, I'll just have to roll it if it's breached. That's if it's not, that's if I can't close it for a winner anytime soon. It's got earnings May 20th. So it's got earnings next week. So either something good or bad will happen. I can either close it if it goes up. If it drops, then I'm going to have to hold on to the trade a little bit longer. All right, next I've got a put spread on ServiceNow, June 18. Now this I opened after earnings. So the stock dropped hard after earnings. So I opened this put spread at 474.60, but then the stock kept dropping even more. It's at 460 right now. So my put spread is breached. I could actually open another one right now because it dropped so much, maybe at around 420. But I don't want to have too many positions in one underlying, especially that I'm not sure how I'll manage it right now. So it's a 10-point wide spread. I collected $2 out of it. I could either sell a call spread a little bit higher to reduce max loss, but I think it'll come back up because it really dropped a lot. I think it has room to come back up. So I'm not too worried about it. I'm not going to sell a call spread because if I do, the call spread could end up being breached, especially that I still have 32 days to go, which is a lot. So if things come back to normal, I'm not worried about this. But if the tech sell-off continues, then this is very problematic. Because my max loss on this is $8, so that's $800 if I don't plan on rolling it or managing it. And definitely, I'm not doing a naked put at this price level, of course. It's too high. And I think even it's a 50% margin requirement stock. Oh, it's actually 30. Okay, good. But I still can't afford to do a naked put at a 460 level. But yeah, so it'll have to be managed by a put spread, a wider put spread, or accepting the loss. Okay, so next I've got pins. This was an earnings trade as well. So there was a week where all my earnings trade went against me. So this I think initially was a 70 put. It got breached and the stock dropped way below. I rolled it to 68 put, so I brought the strike lower by 2 points. It has right now, it expires May 21st. Let's see where pins is at right now. It's at 58, so I'm 10 points in the money on pins. It's going to be hard to roll, but that's my only choice right now. I just have to roll and wait until the stock recovers. And yeah, so yeah, that's really, let's see how much I collected in total on pins. So that's all I could do right now is just wait. Yeah, I collected $1.47 total credits on pins, and so my break even is around 66, and I just need to wait for the stock to come back up. I opened a put spread on the Qs. Actually, I have two of them. So I'm trying to go back to my SPY put spreads. I don't know if you remember my SPY put spreads, which I used to open every Monday, Wednesday, Friday, because the SPY has expiries every Monday, Wednesday, Friday. So the goal was to follow, it sort of follows the general market, a way to follow the general market. If I look at 1 month chart, you could see that, let's say I open a trade here and my expiry is 30 days to go. You could see that the SPY ends up above the strike that the stock. You can see that the SPY, if I sell like an out of the money put spread, you could see that in 30 days it would have been a winner. I could have closed it for 50% around here, and even if I held till expiry, you could see that it would have been a winner. Maybe here it might have gotten breached, but it would have ended up being a winner. And same thing if you go backwards. And if I do 30 days, and I have a video where I talk about that those probabilities. I think it's called Trade the Edge, or you won't believe what the market does 65% of the time, I think. I'll try to link it, but if not, you could search the video on YouTube. So if you look every 30 days, I mean, if we start, because this is a bull market, but still, if you look every 30 days, okay, now the chart stops here. But if we look here, for example, let's say I did a put spread here and I go 30 days, this put spread would have been a winner. Might have been tested around here, but in 30 days, it would have been a winner. And let's say 2 days later, I open another put spread, 30 days to go. Same thing, would have been a winner. And then 2 days later, I open another put spread, would have been a winner. And then 2 days later, I open another put spread, would have been a winner. 2 days later, I open another put spread, it would have been a winner. But let's say, this is a good example because it's the stock market is going up. But let's look at an example where the market is dropping, right? So let me just find a piece of the chart where the market is dropping. I don't know why this stops over here. Maybe because it's 30 minutes. Let's do, I don't know, let's do 1 day. This is ugly. 1 hour. So let's go backwards. So okay, no, that's not 30 days though. Okay, so I'll have to use Yahoo Finance. So let's just look it up quickly here. Let's look up the SPY. So what I'm doing right now is just explaining the put spreads on the SPY put spreads that I'm doing every Monday, Wednesday, Friday. So if I look up the SPY chart, let's click at the chart here and do 1 month, and then let's just go backwards. So the idea behind it is just it's sort of a passive way to sell options. So okay, there we go. There's a good example. So let's say I started a put spread here. 30 days to go. As you can see, it would have been a winner because I could have closed it around here. And even if I held till expiry, because if I start off with an out of the money put spread, if the stock's trading at around right now, I'm looking at a SPY at around 380. My short strike 30 days to go will probably be around 370, 365. So my short strike of 370, 365 over here actually almost got tested. But then at some point, it would have been profitable, would have expired worthless, or I would have closed it for 50% around here. So the idea is to sell every Monday, Wednesday, Friday, 30 days to go. And then let's move 2 days forward. Same thing. I start over here. My stock is at around 390. My short strike is probably going to be 380, for example, because I'm selling an out of the money put spread. Now, 30 days to go, you can see that 380 got tested, and then over here got breached. But that's if I decide to hold till expiry. But most likely I would have closed the trade over around here because it would have been more than 50% profitable. But even if I did hold till expiry, you could see that 30 days later, it is above my short strike of 380. So it would have been a winner regardless. And then let's say we start off here. 2 days later, we sell another put spread. Same thing. Even if one of your put spreads gets breached and loses, most of them will become winners, and the ones that actually are tested or breached, you can manage them by selling a call spread against it and reducing max loss. And because SPY is dropping, that means VIX went up. That means the premiums go up. So the call spread that you're selling to mitigate the put spread that got breached has more value, is giving you more premium. So it's like a self-hedging strategy because as the stock drops, yes, your initial put spread is not doing well, but you can manage it with a call spread that can give you more premiums. But then because the market dropped, because SPY dropped, your new put spread that you're going to open on, let's say the next 2 days or Wednesday, it's going to have a higher premium because VIX is higher. And because VIX is higher, premiums are higher, you can actually go further out. So your short strike is going to be further away from the current market price, a current market price that has already dropped. So your new put spread that is only going to be open 2 days later is actually even further away and actually even safer, so has a better chance of winning. And let's say the market continues to drop, then yes, your Wednesday put spread isn't going to do well either, even though it has a better chance. But once again, that call spread that you're going to sell to mitigate that put spread is going to be worth even more. Your new put spread that you're going to sell on Friday is going to be worth more as well in premiums, and you can go further away as well because VIX is higher. So it's really, that's what I like about it. It's very self-hedging, but you have to accept the loss at some point. And of course, March 2020 was terrible. And the problem that I had in March is that I didn't respect the schedule that I gave myself, which was every Monday, Wednesday, Friday. The problem that I had in March is that whenever the stock, as you remember, SPY would drop the same day 10 or 20 points. So when that happened the same day, I would open another put spread the same day. So I wasn't respecting my Monday, Wednesday, Friday schedule. So I ended up having way too many put spreads open. Plus, I was doing 3 contracts. So I ended up taking a big loss in March with these put spreads. But if I had respected my schedule of Monday, Wednesday, Friday, and if I had done only 1 contract, I probably would have lost only $1,000 in the month of March if I had respected my schedule of Monday, Wednesday, Friday. So I'm trying to go back to 2020 here, March. So I'm in September now. So 2020, March. All right, there we go. Oh, I don't want to remember this. It was terrible. All right, so you could see, let's start with March. So let's say you do a 30-day put spread here. SPY's at 309. Your put spread 30 days to go is probably going to be at around, I don't know, maybe 290. Well, it depends on the VIX as well, but let's say it's around 290. So obviously 30 days later, SPY's at 257. And as you're going through the 30 days, there was no point where you could have closed your 290 for a profit because SPY just kept dropping hard. So that first put spread is going to be a loser for sure. But you would have saved it. You would have reduced max loss by selling a call spread. So that would have been the March 2nd put spread. But then March 4th, you open another one. Same thing. It's going to be the same expiry. Not the same expiry, sorry. It's going to be 30 days later. But it's probably going to be the same strike because SPY is around the same point. So, but then you're moving 30 days forward, right? So yeah, as you can see, this one would also be a loser because SPY is at 251, but you would have saved it with a call spread. Remember, this is March. This is probably one of the worst events ever. So it's not the regular stock market behavior. So now moving forward, we're going to go to March 6th. We're going to open a new put spread. SPY right now is at 293. It had a low of 290, but it had an open of 293. So let's say you sell it at the open. SPY is at 293. So now your new put spread is probably going to be around 270, okay? The short strike is probably going to be around 270. And as you can see, 30 days later, SPY is at 264. So it would have been a loser, but we're getting closer. But you would have saved it with a call spread. You would have reduced max loss. So now you've got 3 put spreads in a row that would have been a loser, but you could have reduced it with call spreads. But that call spread is going to increase in premium. That call spread is going to give you a lot of credit because premiums are high because VIX is high. So now we're going to go to March 9th, which is probably a Monday. You can see that SPY, March 9th, SPY opens at 275. So now your new put spread is going to probably be around 260, maybe? No, not 260, maybe around 250. So 30 days later, you could see that the SPY is at 275. So this put spread would have been a winner if you just held to the expiry. But if you actually held onto it and then decide to manage it while SPY is at 218 on March 23rd, let's say you sold a call spread at the same strike, turning it into an iron butterfly. So you had a 250 put spread, you turned it into an iron butterfly by selling a 250, 255 call spread. So you would have lost on the call spread, but you would have collected a lot of premiums and your max loss wouldn't have been that big. Now, if we go to March 11 now, SPY is at it opens at 280. So you sell, let's say you sell. Actually, the put spread here that you open on March 9th, you open at around, SPY was at 275. You probably could have closed it the next day or the day after because the SPY went up a bit. But let's say you open a new put spread on March 11th, 280. So it's probably, if SPY's at 280, your short strike is probably going to be at around 270. But then as you could see, 30 days later, it's above 278. So that would have been a winner. If you just hold to expiry and you don't even manage it, you could see that you could probably get more winners out of it. But obviously it's hard to just see your max loss of $400 and not manage it. And then let's say 2 days later, March 13, SPY is at 263. You open a new put spread at around, obviously VIX is much higher at this point. So let's say you're able to go to 230. All right. And then 30 days later, SPY is at 280. So that's definitely a winner. And then you go to March 16, which will be a Monday. SPY is at 240. So your put spreads, let's say, is at 210. Your short put spreads at 210. Now you could see at this in this chart over here that the SPY opened at 241, but the high of the day is 256. You could have closed your put spread that you opened at the open. You could have closed it during the day for 50% profit easily. So you probably didn't even have to wait till expiry or 30 days. But let's say you won a hotel expiry. You could see that 30 days later, SPY is at 277. You would have won. And now March 18, SPY opens at 236. You sell a put spread, it's probably going to be at around 200 because VIX is much higher now. You could see that it had a high of 248 at the same day. So you could have closed it the same day, but let's say you hold it, you held it till expiry. SPY is at 286 30 days later. So it would have been a winner. Although a few days later, SPY did drop to 218, but if you decide, your short put we said is around 210 or even 200, so it hasn't been breached yet. All right, so even if you held it, you'd be fine. And then March 20, you open another put spread. SPY opens at 242. You're probably at around 210. A few days later, it's at 218, still not breached. But then 30 days later, it's above your short strike of 210. So another winner. And then at this point, you could see that any put spread you open after this, it's going to be a put spread. It's going to be a winner 30 days later because it's been a bull market ever since. So yeah, so that's the idea behind the 30-day put spreads on the SPY and why Monday, Wednesday, Friday, because I'm basically just going with the market, tracking every movement of the market as much as possible because it's not every day, but it's 3 days a week. So it's pretty much tracking the movement of the market. It's like I'm laddering into the market, into the put spreads. And I just realized this week that the Qs also have 3 days a week put spread. So that's why. So all this to say, this is all to explain why I have put spreads on the Qs. And actually, one of them was so the 300 So I opened one at June 7th expiry at 315. This one almost got breached, but then the next few days I opened another one, and because the Qs fell, my new put spread, as you can see, is at 300 now instead of 315. So this one here, the 315 doesn't look too good, but then the next one that I open looks much better, right? I've got a 300 strike. And this one's actually could have closed it for more than 50% profit, but because of commissions, because I only did one contract, it's going to eat up a lot of my profit. So I'm holding on to it, and maybe I'll try to close these two together, like I closed the SPY, which I don't think I didn't talk about yet. But yeah, maybe I'll close them together just to save on commissions. So that's why I have these put spreads here on the Qs. Next here, I've got a naked put on Root at a 17.5 strike. It has an expiry of December, so I rolled it. I think it was a May 21st expiry. And if I go to executed Root, I collected an extra 86 cents by rolling it from May 21st to December 17. I kept the same strike though. So that's Root for you. And then next I've got Snap. So this was a naked put for earnings. Actually, no, this wasn't for earnings. This was just Snap had a red day one day. So I sold a 49 put for June 18. It's always, most of the time it is profitable, but not enough to close. I think the most I could have closed it for was $1.50. So I collected $2. I sold it for $2. Could have closed it for $1.50, but obviously not enough to close it. I keep putting an order every day to close it for $1, so that would give me a $1 profit. But I've got 32 days to go. Snap is at $53. So yeah, I just have to hold on to it. It looks like it'll be a profitable trade. Sumo here, this is a terrible trade. I've got 2 puts on Sumo at a 30 strike. I went from May 21st to November 19. I collected an extra 96 cents. Now the sad part is, look where Sumo is trading at right now. So If I click on Sumo right now, it is trading at 16.86. My short put is 30. So I'm going to have to wait for a while for this to recover. And I went all the way to November. My total credits on Sumo, though, is $3.56. So my break even is around $26. That's my break even. And the stock is trading at $16. So that's not good. So next, I've got a put spread on Teladoc. This has a June 18 expiry. So 150, 145 put spread. This I just opened when it dropped, but obviously it didn't matter because it dropped even more. I should have opened another one after it dropped, but I didn't get the chance to. I was also thinking of opening a put spread on Fiverr. Would have been closed already by now, but yeah, I missed it. Anyway, so Teladoc, I've got a 150, 145 put spread. It's at 139 right now, but it's got a June 18 expiry. So I'm going to hold on to it, and then I'll decide how I'll manage it if it's breached by then. Let's just see. I think it's a 50% margin requirement stock. Yeah, 50%. So I'm not going to turn it into a naked put, that's for sure. So I'll most likely manage it by increasing the width of the spread. All right, so that's for Teladoc. Okay, I think I jumped Snow. I jumped Spotify. How could I jump Spotify? So let's go to Snow. So Snow was an earnings trade that went bad. I rolled it all the way to December. It was a 5-point wide spread. I turned it into a 10-point wide spread. December 17, and my short strike is 220. Right now, Snow is at 210. So at some point it was at 190 though this week. It's very volatile, but yeah, I've got until December, so I'm not gonna worry about it right now. Spotify that's the one that's killing me right now because Spotify was trading at around 290. Actually, let's look at this. Let's look at the chart. This is ridiculous. I don't regret playing this trade. I just think I'm very unlucky. So Spotify was at 294 before earnings announcement. I sold a 260 put, so that's more than 30 points away. Spotify dropped below 260 right after earnings, and then it closed. So I had to roll it. I rolled it to 257.5 the following week, which was also breached. So then I had to roll it to 250 all the way to July for a credit. And as you can see, Spotify just keeps dropping. At some point, it was at 217 this week. If we look at the 5-day chart, look over here. It was at 214. It was at 214. So this one's bad. Now I really need Spotify to come back above 250. It's at 223 right now. It's a 30% margin requirement stock, so that doesn't worry me. The problem is that it's taking a lot of buying power out of me because I'm in the money. Because my short put is in the money, it's taking a lot of buying power out of me. So let's say Spotify is at 223 right now. It's taking $9,000 of capital out of me right now. $9,000 of maintenance excess. So if I go back to Questrade, maintenance excess, balance. So this line here, it's taking $9,000 out of me. So I used to be at around 36 maintenance excess, and this week it dropped all the way down to 15,000 because of Spotify. And now it's back up to 21,000, but I'm still easily $15,000 below what my normal maintenance excess is. And most likely it's because of all my short, all of my in the money short puts. So all these are in the money, and there was another one here. Snap. There was pins as well, in the money as well. So yeah, that doesn't help, of course. But it's mostly because of Spotify. That's problematic. But I'm confident in Spotify that it'll come back up. I don't think it deserves what happened to it. But it's just I don't know how much time it's gonna take to come back up. And in the meantime, it's stressing me out, right? So that's the problem with Spotify, and it's taking up a lot of buying power that I could be using to do something else. Most likely, I won't be using it for something else. I rarely use all my buying power, but it's just in theory that's what's bad about it. Oh, and there's another one that's in the money. Twitter, put option on Twitter. Twitter's at 51.73. My short put is 59 for next week. So most likely this I'm gonna have to roll again. This was an earnings trade, went against me and just kept dropping with the tech sell-off. And then I've got Wish here that I rolled yesterday to December. So it was a May 21st expiry. I had the 20 put. So where's Wish over here? Yeah, right there. May 21st, it was a 20 put. I rolled from May 21st to December 17, collected an extra 60 cents. And my Wish naked put here has a total credit of $2.80. So my break even is about $17 on Wish. And do you want to see where Wish is trading at right now? It is trading, if I go to positions, Wish is trading at 9.79. So 50% lower than my short put. So yeah. I really regret playing these stocks. This was at a point where I couldn't find anything to trade, so I was basically just looking at MarketChameleon to see what has high volatility. And this Wish was on the list, Sumo was on the list, Root was on the list, and I had a lot of winners with these stocks, but then at some point they just this happened, they dropped 50%. So yeah, I think next time, if I can get out of these trades, I'm just going to be more selective I'm going to stick to a watch list. I don't care if they have high volatility or not, because although if you want to sell options, it's important to sell. You're selling volatility basically, so you should be selling stocks that have high volatility. But sometimes these unknown stocks or these speculative stocks, they tend to move more than the implied volatility in them, and and then you get caught. And that's if you get caught only if you try to save them. But if you just accept a loss, then maybe you end up winning at the end, because you don't end up holding on to the trade longer than you should. You take the loss and you just move on and you play something else that has high implied volatility. I mean, that could be another strategy. It's just to keep focusing on high implied volatility. Just keep playing high implied volatility. But if you lose, you don't try to save it. You just close it, take the loss, and move on. I'm not sure if that's something I'm comfortable with, but I think in theory it could make sense, because you're always playing high implied volatility. Sometimes you'll lose, but you'll win more times than you'll lose. And then when you lose, you just take the loss and move on. That could be a potential strategy, something to look into. All right, so now to my TFSA. So I started some small positions as a buy and hold. I bought some AMD at 76, obviously not the best entry because it dropped to 72 last week. I bought some Alibaba at 223, not the best entry as well. It dropped, I think, to 206. I'm comfortable buying more of them if they drop more than 10% of my initial purchase price. So I've got no problem with that. I've got a covered call on GHVI, which is the SPAC that will bring Mavenport public. So I like the technology, so that's why I'm comfortable. That's why I made the purchase. I'm obviously down on the shares. I bought it at 13.4. It's trading at 11.43, but I'm selling covered calls on it. So I'll sell as long as I'll keep selling as much as I can. And if I can't, I don't mind holding on to the shares. I've got some gold ETF. So I bought in twice. So this I bought once at 180, and then another time I believe at one. I don't remember the second time, but my average cost is 169. So I must have bought it around 160, so that my average cost is 169. And now gold is at 172, so it's showing a small profit. I've got a covered call on HIMS. At some point it was profitable, but not anymore, with HIMS being at $8.84. All I could do now is keep selling covered calls on it until it recovers. And I've got Unity here. I bought a few shares. I saw it drop so much, so more like a buy and hold, or maybe even a swing trade. I mean, if it's showing a decent profit, I'll just close it for a profit. I'm not sure, but I just felt like I needed to buy something. It dropped so much, and it's not a bad stock. So just one of those undeserving stocks that just keep dropping. All right, next, my RSP, just a bunch of covered calls. Most of them are breached, or not breached, but below my cost, which is including the call premium that I collected. So this one, actually, let's look at the spreadsheet. My APXT, where's APXT? My cost on APXT is, where's APXT? I must have gone far with it. So I think it's a July expiry, or maybe a May expiry. Looks like I don't even have it. Oh, there it is. Okay, so my cost is 12. And right now the stock is trading at $10. So yeah, I'll just keep selling calls again at a 12.5 strike. Fubo, my cost is 25.64 minus 4.64. So my cost is $21. And as you can see, the stock's at 20. So this one's not so bad, actually. I'm not that far off. It's not so bad. Luminar is pretty bad. My cost is around 25 or 24. So 29.5 minus 5 call premium that I collected. And as you can see, the stock's at 21. So this one's $4 below my cost. This is a SPAC that I just want to get rid of when I get the chance. Rocket, yeah, this is pretty bad. So it dropped after earnings. I've got a covered call. My cost is exactly $20. 22.82 minus 2.82. And the stock's at 17.34. So all I could do is I'll keep selling covered calls on it. Sadly though, the premium won't be a lot. So for example, if I want to sell, let's say the June 18 22 strike, there isn't even a 22 strike, so let's say 21.89. As you can see, I could only collect 19 cents, so it's not much. Might have to come closer, but then I'll end up losing my shares at a lower strike, and it only gives me 26 cents. So maybe I'll have to go further. Let's say I go to September and then I go to 21.89. I could collect 93 cents. So as you can see, that's the problem with covered calls when your stocks drop 50%. Well, not 50%, when they drop a lot. All right. So it's still important to have a good entry with covered calls. All right, so next I've got our RMO that it was a naked put in my margin account, but I transferred it to my RSP because it was a 50% margin requirement stock. So my strike is actually 15. Yeah, it's a 50% margin requirement stock. So my strike is 15 and the stock is at 6.9. So it dropped 50% below my short strike. And actually, let's see what my cost is. My cost is $12.60. So I'm just gonna keep selling covered calls until it comes back up. That's all I could do. Skills, probably the same thing. Yeah, my cost actually not that far off. My cost is around 20. Actually, let's look at the spreadsheet. Skills, my cost is 17.2, and the stock is trading at 15.4. So it's not so bad. Not so bad. SNPR, yeah, this one has my strike is 15. Let's look at my cost on SNPR. My cost is $12.23, and the stock is trading at 9. Okay, it could be worse. And finally, in my RSP Virgin Galactic, my cost is around 21, I think. Here, let's look at the spreadsheet. SPCE, my cost is 21.4. The stock is trading at 16.18. So yeah, not good. All I could do is continue selling covered calls. Now, I could sell at the 23 strike, or I could sell at my cost strike. So my cost is 21.4. So I could sell at the 21 strike. I'll collect higher premium. But if the stock rallies and goes above 21, then I lose my shares at 21. So I miss out on the initial premiums that I collected the first time. But that's not bad if I just want to save the trade. I'll still make a small profit, but then I would have wasted all this time holding the stock just for a smaller amount of profit. And finally, in my RSP, I've got 3 covered calls: LI, Shift, and Wish. So this one, forget this one. This one's doing terrible. But as you can see, I'm making $740 on the covered call, but my cost on the whole trade is $15, and the stock is at $9. So that's not good. But definitely what I'm going to do next is I'm going to sell a covered call at a 15 strike. I'm not going to sell at a 22.5 strike. I'm going to bring it down to 15 and just try to recover this trade. This one's not bad. I mean, it's not, if you look at the open P&L on the shares and the covered call, it's showing a small loss. So this one's not a big deal. And I think this one's bad. Yeah. So this one, my cost is around $21. And as you can see, the stock's trading at 18. But all I could do is I'll sell covered calls, try to sell it above my strike if possible, and wait until the stock comes back up. So yeah, so that's what I'm holding in my Questrade portfolio. So as you can see, it's a lot of option selling strategies. So in my TFSA, I've got a few positions that I'm thinking of buying and holding, but most likely I will probably sell. So it'll probably be a swing trade. So yeah, so that was my portfolio. Let me know what you think in the comments section below. I'm always open to suggestions, things to buy. I mean, with inflation, I don't want to have cash. I am sitting on cash, but I just don't trust anything to buy. That's the problem. Everything's at all-time highs, although there was a good tech sell-off this week, but nothing very interesting, or not confident in much either, or not confident enough to do covered calls on them either. So plus I don't like buying and holding because I'm just not patient. That's not my strategy. My strategy is to have a portfolio that produces income. Even if buying and holding would have generated more profits in the long run, that's what I want. That's a strategy that I'm looking for, is to have a portfolio that produces income for me, and not 4% dividend per year. That's not what I'm looking for either. So that's why I'm trying to sell these options, and that's why I lean more towards option selling strategies. All right, so if you have any questions, leave in the comments section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free commissions. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.